Investing in growth. A risk-taking financial approach with the capacity to create enormous wealth from small investments. Imagine having the ability to predict the next Google or Amazon, companies that have seen rapid growth and provided significant returns to their investors. That's how growth investing works. It all comes down to concentrating on businesses that have above-average potential for profits, revenue, and market value growth. It all comes down to having the foresight to recognize an organization's potential and the persistence to wait for it to materialize. However, finding winners isn't the only aspect of growth investing. It involves controlling risk and volatility and broadening your investment holdings to take advantage of expansion prospects in other industries and regions. Recall that growth investing is a marathon, not a sprint. This is a buy and hold strategy that calls for endurance and a long-term outlook. Are you prepared to harness the potential of growth investing now? Are you prepared to seize the opportunity to become today's market leaders tomorrow? Since growth investing is centered around that. However, precisely what is growth investing? Let's dispel the mystery surrounding it. The goal of the growth investing strategy is capital appreciation. Finding businesses that show above-average growth in terms of sales, earnings, or market value is the key, even if the share price looks high when compared to other financial ratios like price to book or price to earnings. Consider it as searching for the next big thing, the businesses that have the potential to lead their respective industries in the future. These are frequently encountered in rapidly expanding sectors like technology and renewable energy. Purchasing these businesses and holding onto your investments for a long time is the aim here in order to profit from long-term capital growth. Let's go back in time together. Recall the days when Google was just an exciting search engine and Amazon was a little online book retailer. Investors that kept onto their shares after seeing their growth potential early on have profited handsomely. These are archetypal instances of prosperous development investing. But the journey isn't always easy. Investments in growth stocks can be riskier and more volatile than other kinds. However, the potential benefits can outweigh the dangers if you have the correct information and strategy. It all comes down to exercising patience, adhering to your plan, and not letting the short-term changes in the market derail you. Growth investment is essentially about identifying potential industry leaders and capitalizing on their success. How then do we identify these businesses with strong growth potential? You might inquire. The secret to identifying growth-oriented assets is to comprehend the critical indicators that indicate a business's potential for growth. We start by examining revenue growth. Businesses that show a steady upward trend in their revenue growth are frequently strong candidates for growth investment. The logic is straightforward. A business is expanding if it is selling more of its goods or services. However, income growth is only one aspect of the whole. The possibility for earnings must also be considered. Here, we look at the earnings of the company and, more significantly, its potential for future earnings. Strong earnings growth typically enables a corporation to reinvest its profits back into the company, resulting in additional business expansion and, consequently, increased investment value. We then look at market trends. We can discover businesses that will profit from these more significant changes in the economy by recognizing the sectors and industries that are expanding. Consider the technological boom of the late 1990s or the recent 10-year explosion in green energy. Businesses in these industries, so to speak, had the wind at their backs, which frequently resulted in notable growth. Let's now examine a case study: Amazon. An investor examining Amazon in its early years would have witnessed remarkable revenue growth as more and more people began making purchases online. They would have observed that as Amazon entered new areas like cloud computing and digital streaming, it had significant profit potential. Naturally, they would have also been aware of the expanding trends in digital services and e-commerce. These all suggested that Amazon was an asset with growth potential. But keep in mind that pinpointing assets with room for growth is not a precise science. It needs a strong sense of intuition, as well as an acute awareness of market dynamics and trends. It involves a lot of strategy, art, and science in equal measure. Finding growth-oriented assets requires a great deal of strategy, art, and science. Now that we are aware of the key components, how can we develop an effective growth investing strategy? Building a diverse portfolio should come first and foremost. Diversification reduces risk and makes it easier to take advantage of growth prospects in many industries and regions. Recall that not every growth stock will experience the same level of success or rate of growth. You might potentially improve your total profits and weather market changes by diversifying your investments. However, how can you spot these chances for growth? It all comes down to closely monitoring disruptive technology and new industry trends. These are the places where tomorrow's fast-growing businesses are frequently found. For example, the early 21st century tech boom gave rise to corporations like Google and Amazon, both of which have seen substantial long-term growth. Therefore, stay abreast of innovations. Keep an eye out for businesses that are leading the way in these innovations and keep an eye on industry trends and breakthroughs. These companies are frequently identified by their rapidly increasing sales, growing market share, and cutting-edge goods and services. Another essential element of any effective growth investment strategy is risk management. Since growth stocks might be more erratic, it's critical to weigh the advantages and disadvantages of investing in them. This entails examining financial documents closely, performing in-depth industry analysis, and comprehending the competitive environment. Recall that growth investment demands patience and a long-term outlook. The buy-and-hold strategy entails hanging onto investments for a considerable amount of time in order to reap the rewards of long-term financial growth. This strategy offers the chance to weather market volatility in addition to lowering transaction costs and tax effects. Finally, ongoing study, flexibility, and observation are critical. The investing landscape is dynamic and ever-evolving. What is effective now might not be tomorrow. Thus, be adaptable, knowledgeable, and prepared to modify your plan of action as needed. The quest of long-term financial success can be aided by a well-designed growth investing strategy. Growth investing is a marathon, not a sprint. Now let's discuss long-term success. The path to long-term financial success in growth investing isn't always easy. There will be peaks and valleys, with the occasional deep and protracted valley. But keep in mind that the goal is the marathon, not the sprint. Sustaining the course requires constant monitoring, adaptation, and study. Proficient growth investors maintain a close eye on economic data, industry developments, and market trends. They actively manage their assets, making required portfolio adjustments to take advantage of new growth possibilities and reduce risks, rather than simply buying and letting their money grow. Consider the tale of Amazon, a shining example of a business that saw tremendous long-term success. Huge profits have been realized by early investors who saw the potential and persisted through the dot-com bubble crash and subsequent market changes. This is not a story of quick riches. Rather, it is an illustration of the value of perseverance and long-term thinking in growth investing. Another essential quality of prosperous growth investors is adaptability. The market is always evolving, and so are the industries and businesses that drive growth. Long-term profits can be greatly increased by investors who are willing to change course when needed, to seize on new chances, and to quit failing investments. Lastly, a crucial component of growth investing is keeping an eye on your investments. Long-term success requires monitoring your holdings, analyzing their performance on a regular basis, and making any modifications. Recall that investing in growth doesn't mean setting it and forgetting it. It's about taking responsibility for your financial future. So, keep in mind these three pillars: constant study, adaptation, and monitoring if you're prepared to take on the marathon that is growth investment. With these instruments at your disposal, you can ride out the ups and downs of the market and possibly benefit from long-term development. The keys to long-term success in growth investing are strategic foresight, patience, and endurance. Let's review and explore growth investing's possibilities. We have thoroughly examined growth investment, comprehending its guiding principles, recognizing growth-oriented assets, and investigating long-term success-oriented tactics. This trip has demonstrated to us how growth investing targets businesses with above-average potential, businesses that have the capacity to completely transform markets and sectors. The importance of a buy-and-hold strategy, which promotes holding onto investments for longer periods of time in order to maximize long-term capital appreciation while minimizing transaction costs and tax implications, has also been highlighted by us. We've also learned to endure market turbulence. Realizing that the secret to handling the inherent risks associated with growth investment is to have both patience and a long-term outlook. We now know how critical it is to diversify, to put our eggs in several baskets in order to take advantage of development prospects in a variety of industries and regions. Never forget how important it is to always evaluate, adjust, and keep an eye on your investments. The most successful investors are those that maintain their knowledge and adaptability in the ever-changing world of investment. Thus, as we come to an end to this voyage, I urge you to look into investing options that are growth-oriented. Above everything, exercise bravery, patience, and comprehensive investigation. For growth investing is a process rather than a final goal. It's a chance to benefit from advancement and innovation in order to achieve long-term financial success. The unsung hero of the financial world when it comes to accumulating money is dividend investing. Welcome to the fascinating world of dividend investing. With the right knowledge and application, this approach can produce a steady stream of passive income and act as a pillar of stability for investors in a market that is frequently erratic. Imagine this. A profitable business accepts your investment in exchange for your trust and gives you a cut of the earnings. These benefits, referred to as dividends, are usually given out as extra stock shares or cash payments. However, the allure of dividends extends beyond the act of receiving these payments. As you can see, dividends are a strategic tool for building wealth rather than just a source of income. Imagine a snowball that keeps getting bigger as it rolls down a hill. That is the dividend reinvestment power. Reinvesting your dividends is effectively purchasing additional stock in the firm, which could result in future dividend increases that are even higher. It's a growth cycle that can support your prosperity financially. It is important to look for businesses that have a history of sound financial management and dividend payments. The company's payout ratio, cash flow, earnings forecasts, debt-to-equity ratio, dividend distribution history, and market conditions are among the variables to take into account. Yes, there is preparation involved, but keep in mind that when it comes to investing, knowledge really is power. Moreover, the likelihood of earning dividends rises with the duration of ownership of dividend-paying stocks. It's a tactic that pays off in patience, a quality that's sometimes undervalued in the hectic world of today. Not to be overlooked is diversification. You can spread your investments throughout a number of industries to lower risk and build up a buffer against market volatility. Are you prepared to start this trip now? To take advantage of dividends and establish a reliable source of passive income? Enter the world of dividends, where steady income growth coexists with constancy. Scene synopsis. The monetary fruit of your investment tree is called a dividend. Now let's explore the dividend world. Consider an investment tree. Investing in stocks allows you to plant financial seeds into a company's fertile ground. The fruit that the tree bears as it matures, a percentage of a business's profits that are given to shareholders is known as a dividend. They act as a material expression of gratitude from the business for your support and faith in them throughout their expansion process. Dividends come in two primary forms: cash payments and equity dividends. Cash dividends are quite simple to understand. The amount each share that the corporation pays you depends on how many shares you possess. Without requiring you to sell any of your shares, this money appears directly in your account and provides a consistent income stream. Dividends on stocks, however, work a little differently. Shareholders receive more firm shares as compensation rather than cash. This can be a really useful method of progressively raising your ownership position in the business without needing to make additional financial contributions. A corporation shares its success with you through dividends. They serve as a gauge of the stability and profitability of an organization's finances. Recurring dividend payments are an indication of a company's sound financial standing and outlook for profits. But it's crucial to keep in mind that not every business pays dividends. Some may decide to put their profits back into the company in order to help it develop and expand. This merely indicates that these businesses have a different approach to utilizing their income, which does not imply that they are unsound investments. Dividends are essentially a portion of a company's profits distributed to investors, acting as a kind of passive income. They are the benefits you get for believing in a company's potential and contributing to its success. Dividends. The benefits received from your initial investment. Selecting dividend stocks requires research, wisdom, and foresight. It's important to choose stocks that offer consistency and steady returns rather than simply any dividend-paying company. Now let's explore this. Take into account the company's dividend payout history first. Firms that have demonstrated a consistent and growing dividend-paying history are encouraging. It demonstrates the company's dedication to giving shareholders their money back and its stability financially. Consider the payout ratio after that. This represents the portion of profits that a business distributes as dividends. An excessively high payout ratio could suggest that the business is not spending enough in its expansion, while an excessively low payout ratio could suggest that the business is not dedicated to providing a return to its shareholders. A healthy payout ratio typically strikes a balance between reward and growth in the middle. Let's now discuss cash flow. Strong cash flows increase the likelihood that a company can pay its dividends. It's also a useful gauge of the company's financial health because it demonstrates its cash generation capacity, which is essential for dividend payments. Estimates of earnings are still another crucial element. Generally speaking, larger profits translate into larger dividends. Therefore, you want to invest in firms that are anticipated to improve their earnings. It's important to take the debt-to-equity ratio into account. It shows the proportion of debt financing the business has in relation to shareholder equity. A high debt-to-equity ratio could indicate that the business is highly dependent on debt, which could have an effect on its dividend payment capacity. Last but not least, keep in mind market dynamics. Gaining an understanding of the company's industry, rivals, and market trends will help you assess the company's prospects and dividend sustainability. You may be wondering now how the return on a dividend stock is calculated. This is where the idea of dividend yield enters the picture. It is calculated by dividing the dividend payment each year by the stock's current market value. A larger yield may appear desirable, but it's not necessarily preferable. It's crucial to carefully evaluate the yield in light of the firm's overall financial health because an excessively high yield may indicate that the market doesn't believe the company can continue to pay dividends. Selecting the appropriate dividend stocks creates the foundation for a consistent income flow. It's important to comprehend the business, its state of finances, and its dedication to shareholders. Put on your analytical hat and begin your quest to accumulating riches through steady passive income. Creating a dividend portfolio is a calculated step toward ongoing passive income. Consider your stocks as an orchestra, with each instrument contributing a distinct song and all contributing to the creation of a stunning symphony through harmony. Creating a diversified dividend portfolio is essentially this. How do you get there, though? Let's first review diversification. It's the opposite of placing all your eggs in one basket when it comes to investments. You distribute your investments among several industries, geographical areas, and businesses of various sizes. In this manner, your whole portfolio is protected in the event that one stock or industry underperforms. However, diversification also aims to maximize rewards in addition to distributing risk. Every industry has an own economic cycle. Next, let's talk about owning stocks for a longer time. Patience is a virtue in the world of dividends. You can benefit from compounding dividends if you hold onto stocks for a long time. You can reinvest every cash dividend you get to purchase additional shares and increase your dividend income. Over time, this snowball effect can greatly increase your returns. Moreover, financially secure businesses are frequently those with a track record of steadily increasing their dividend payments. They'll probably keep giving you dividends, which will give you a reliable source of passive income. But creating a portfolio is a continuous process. It is essential to monitor and control regularly. This does not imply that you must constantly monitor your investments. Rather, the focus should be on monitoring the company's core competencies. Do they continue to pay out at a healthy ratio? Does their cash flow look good? Do they have any bearing on the market today? It's also critical to routinely review your portfolio. It's possible that some stocks have increased significantly, or that some are underperforming expectations. Rebalancing your portfolio periodically is a smart idea to keep it in line with your investing objectives and risk tolerance. Recall that the goal of a dividend portfolio is not to pursue the greatest yield. Locating dependable businesses with a history of consistent dividend payments and room to grow is key. That's the art of creating and overseeing a dividend portfolio. It's not a race, but a trip. However, you may build a portfolio that sings the lovely tune of passive income with perseverance, research, and a pinch of strategic thought. An intelligently managed dividend portfolio is your ticket to sustained financial security. Investing in dividends offers a wealth of opportunities, but it also has drawbacks. A lot of people find dividend investing to be a popular approach because of the appeal of steady passive income. There are 3 advantages: stability, compounding, and consistent income. The biggest benefit is having a steady paycheck. Businesses that pay dividends to their shareholders give them a reliable source of income, which is especially desirable in retirement or other uncertain financial times. And there's the compounding power. Over time, investors can dramatically expand their holdings by reinvesting dividends back into the purchase of further shares. A snowball effect may result from this, in which your investment's value increases dramatically while you continue to get dividends in tandem. Finally, dividend investment provides some stability. Businesses with a track record of profitability and stability are usually the ones that pay dividends on a regular basis. These businesses frequently do well during market downturns, giving investors a safety net. However, dividend investing carries certain risk, just like any other investing approach. Share prices may fluctuate as a result of market volatility, which could affect the return on your investment. Even while a company's history of dividend payments is reassuring, payouts can and are reduced by the company, especially during difficult financial circumstances. Even strong businesses may encounter unforeseen difficulties that require them to cut back on or stop paying dividends. To reduce these risks, it is essential to diversify your portfolio by distributing your investments across several markets and businesses. Dividend investment has seen its fair share of sunny days and stormy seas. It has the excitement of compounding and the guarantee of consistent income, but it also has the risk of market volatility and possible dividend reductions. You may, however, negotiate these waters with the aid of a balanced viewpoint. To confidently navigate the financial waters, it is essential to comprehend the benefits and hazards associated with dividend investing. A journey towards consistent wealth creation through dividend investing. Let's pause for a moment to reflect on the route we've taken today. A route that has the potential to provide you with a reliable source of passive income. We started by introducing the idea of dividends, which are those enticing, consistent payments that businesses give to their owners. Recall that these dividends may come in the form of extra stock dividends or cash payments. This income stream is charming because it is passive. As long as you hang onto your shares, your money makes money for you. After that, we looked at methods for choosing dividend-paying equities. It's important to look for dividend-paying companies that have a track record of consistent dividend payments, a healthy payout ratio, robust cash flow, optimistic earnings estimates, a reasonable debt-to-equity ratio, and advantageous market conditions. It's about taking a broad view. We then looked at the skill of creating and overseeing a dividend portfolio. We gained knowledge about the significance of long-term investing concepts, the evaluation of dividend yield, and the significance of diversification. Recall that the longer you own your stocks, the greater the likelihood that you will get dividend payments. Next, we evaluated the benefits and dangers associated with dividend investment. We were astounded by the stability dividend investment can offer, the power of compound interest, and the advantages of consistent income. However, we weren't afraid to talk about the possible hazards, like dividend reductions and market volatility. As is the case with all investments, maintaining a balanced viewpoint is essential. It's your turn to move now. Take into account including dividend investment in your overall financial plan. Step beyond the box and explore the lucrative world of dividends. A clever method for creating a passive income stream from your investments is dividend investing. Envision planting seeds in the rich soil of the financial market and then watching with pleasure as the plants grow and regularly produce dividends. The portions of a company's earnings that are distributed to shareholders, usually on a quarterly basis, are known as these fruits of your investment, or dividends. Putting money into dividend-paying stocks is similar to creating a steady income stream that deposits directly into your bank account. And the whole thing's beauty? Compared to investing in firms that don't pay dividends, it is less volatile and can serve as an inflation hedge. Dividends are a great way to increase wealth and stability in your finances, not just a perk. What precisely is dividend investing, then? That inquiry, though, leads to a plethora of opportunities. In its most basic form, dividend investing is the act of making investments in businesses that distribute a percentage of their profits to shareholders on a regular basis, typically on a quarterly basis. We refer to this as a dividend. But don't let its ease of use mislead you. The power of dividend investment is immense. It can serve as a safety net in erratic markets in addition to supplying a consistent revenue source. You might wonder, how? Well, businesses that distribute their profits to shareholders are typically sound and secure financially, offering a level of assurance that equities that do not pay dividends might not. Furthermore, you can accelerate the growth of your wealth by reinvested dividends, which have the potential to compound gains over time. Imagine it as a snowball that is rolling down a hill, growing larger and larger with each round. That is how compounding works its magic. However, dividend investing carries certain risk. Just like any other investing strategy. For example, in lean times, a business may reduce its dividends, which would impact your source of income. Furthermore, concentrating only on firms with high dividend yields may cause you to miss out on other growth prospects. As a result, it's critical to diversify your holdings and avoid putting all of your eggs in one basket. Furthermore, it's critical to keep in mind that not all stocks that pay dividends are made equally. When picking attractive dividend stocks, one should take into account various factors, including the company's financial health, growth, payout ratio, dividend yield, and industry trends. However, there will be more about that in the part that follows. Consequently, dividend investing is a calculated strategy to provide consistent income and increase wealth over time. It comes down to identifying trustworthy businesses that are dedicated to giving their shareholders a cut of their success. Furthermore, even though perseverance and hard work may be necessary, the benefits may well outweigh the effort. So how can you find stocks that pay dividends? This is an important question that requires a thoughtful response. As you can see, not every stock is made equal and not every stock offers dividends. How then can you sort through the haystack and locate those needles of gold that are called dividend-paying stocks? Start by taking a look at the company's payout record. A company's financial stability and dedication to giving shareholders their money back can be inferred from its track record of dividend payments. Seek out companies that have a track record of raising their dividends over time in addition to paying them on a regular basis. Second, consider the yield on your investment. This is the dividend payout split by the market price of the stock as of right now. Although a larger dividend yield could be alluring, proceed with caution. Occasionally, an exceptionally high yield may be a warning sign of impending financial trouble for the business. Consequently, it's critical to strike a balance between knowing the company's general financial condition and searching for a solid yield. Finally, think about the company's expansion. Businesses with significant room for expansion are more likely to gradually raise dividend payouts. Seek out businesses with a competitive edge, strong financial performance, and a leadership position in their sector. Allow me to explain via a case study. Let us consider the corporation, DV Corp. DV Corp has continuously distributed dividends to its stockholders for the last 10 years. Its dividend yield is competitive with that of other companies in its industry and is affordable. Furthermore, DV Corp has demonstrated robust growth, increasing its earnings and market share year after year. In this case, DV Corp can be a good option to consider when looking for dependable dividend stocks. Recall that choosing firms with a track record of dividend payments and room to grow is essential to effective dividend investing. Now let's explore some effective dividend investing ideas. In order to succeed in this field, one must establish a well-balanced portfolio and practice excellent risk management in addition to selecting equities with high payout ratios. To begin with, think about building your portfolio from a variety of dividend-paying equities from various industry areas. Your investments can be protected by this diversification from market volatility and hazards unique to a given industry. For example, your portfolio will probably suffer if you invest only in technology equities and the tech sector suffers. However, if your investments are dispersed among multiple industries, a decline in one could be counterbalanced by growth or stability in another. Let's now discuss risk management. Refrain from falling for corporations that offer astronomically high dividend yields. These could be warning signs of impending financial crisis. Rather, search for businesses that have a stable payout ratio and a history of dividend payments. You can determine if a company can continue paying dividends at its current pace by looking at the payout ratio, which is the percentage of earnings that the company distributes as dividends. A payout ratio of less than 70% is what you should ideally aim for. Compounding, or the practice of reinvested dividends, is another important tactic. Reinvesting your dividends allows you to purchase additional shares of the dividend-paying company. This extra stock will then produce more dividends, starting a positive feedback loop. Even in the case of a somewhat stable stock price, the compounding effect has the potential to greatly boost the value of your portfolio over time. Maintaining an eye toward the long term is also crucial. Although dividend investment can yield a consistent income stream, its full potential is only fully realized in the long run. When it comes to dividend investing, patience is a virtue. Refrain from trading stocks based on whims of the short-term market. Rather, concentrate on assembling a portfolio of reputable dividend-paying equities that you can own for an extended period of time. Investing in dividends can be a strong tool for your financial progress if you approach it carefully. It pays to be patient, particularly when investing in dividends. Anyone who has ever dabbled in the world of dividends can attest to the truth of this maxim. This investment method has several long-term rewards, but they all depend on three essential elements: dividend sustainability, company analysis, and patience. The essential component of dividend investing is patience, which is not the same as apathy. It's important to realize that dividends' true ability to increase wealth over time is reflected in their compounding ability. Consider the snowball effect. Your income potential increases as you reinvest your dividends to purchase further shares, building an ever larger snowball of wealth. Company analysis is important next. Crucial factors to take into account include a company's financial stability, standing in the industry, and capacity to maintain and increase dividends over time. It's important to consider the firm behind the dividend yield in addition to the yield itself. A company that has a track record of consistent distributions, strong growth potential, and a fair payout ratio is a valuable addition to the portfolio of any dividend investor. Dividend sustainability is crucial. To sum up, in addition to sharing profits, a company that regularly distributes dividends demonstrates its stability financially and its dedication to its owners. A firm with a sustainable dividend is one that is likely to withstand economic downturns and keep giving its investors a reliable source of income. And who better than the successful investors themselves to demonstrate the potential of dividend investing? Think about the tale of the dividend diplomats, two astute investors who used methodical dividend investing to create a sizable revenue stream. Consider the example of dividend mantra, who at a young age became financially independent by making calculated investments in dividend-paying equities. These are not anomalies. Rather, they serve as illustrations of what is possible when dividend investing is done correctly. The long-term goal is steady, continuous growth rather than rapid successes. Investing in dividends is a long-term endeavor that yields substantial returns for prudent players. Let this serve as your compass while you explore the fascinating world of dividends and accumulate money through consistent income. In conclusion, dividend investing is a sound method for accumulating wealth and generating consistent income. We have gone over the essentials of this strategy, including what dividend investing is and how to recognize dividend stocks. We've also looked at successful dividend investment techniques and the long-term advantages that come with it. Just keep in mind that your finest allies in this situation will be perseverance and in-depth study. Take into account the company's growth, payout ratio, dividend yield, industry and market trends, and overall financial health. Don't focus only on large yields. Sustainability is essential. Remember that dividend reinvestment and diversification can help you compound your earnings over time. Why not explore the field of dividend investment now? Examine these sources of consistent income and consider how they can help you on your path to wealth creation and financial security. Since information is power, you now possess the understanding required to make wise investing choices. Recall that the growth potential and steady income of dividends are what give them their power. Investigate dividend investing now to start making money work for you.